Hey everyone, hope you're doing well. This is Drew Creekmer here with Senior Wealth Advisor John Creekmer, and we're doing a deep dive today. We're going to hop into some current events that we have going on in our local markets from a firm level. And we're going to talk about, hey, what in the world is happening with interest rates and inflation and bonds, and what do we do about it? But before we dive into it, John, how you doing today? Is it cold and rainy in your neck of the woods, or is it sunny and 75?
I tell you, it's sunny today, and so which is a cool thing. I love the temperature change in the spring, and just talking to Jerry on the phone, and he was talking about cutting his grass today. So it's great whenever you can smell that fresh cut grass. I know out in DC it was like 85 yesterday, wasn't it?
Yeah, so you got up in the mid 80s, and you can't tell it, but I am casual underneath the video screen. I'm wearing my shorts today, so
Nice,
there we go.
nice. The I know I'm wearing pastel blues, so that means my goal this week is to wear a pastel color every single day. And so to say I'm embracing spring no matter what the weather is outside.
Yeah, there you go. There you go. You're getting in the zone. You're getting in the zone. It's Easter season, so it's time to break out the pastels. So,
Yeah, for
hey,
sure.
let's kind of talk about a major event that we have going on in East Peoria. It's coming up here on Thursday, the 21st, and this event is called The Truth, which love the name, lines up with our one of our main ideals here about true wealth at Creekmore Wealth. And so, John, this is something we've been planning for a while. We would invite everyone to attend in Central Illinois if you can. We'll include the link here so you can go and save your seat and register. It'll be a great just highlight with an economist on things that are going on. If you can't make it in person, though, we will be live streaming the event on Facebook Live as well, where you can catch the video if you aren't able to make it in person. So, John, can you kind of give us a high level overview of what you and Andrew are going to be covering at The Truth?
Yeah, I think it's kind of funny. We're having a senior economist named Andrew Updike from one of our huge partner firms, First Trust Portfolios. They manage, I don't know, Drew, like 140, 150
Yeah.
billion dollars. They're a large firm in Chicago. Their economics team is one of the most highly regarded firms in the entire world. Extremely accurate as far as on analyzing and predicting as far as where things are going from an economic standpoint. And so we're blessed to have Andrew here, who's a dear friend of our firm. And he actually, I just talked to him this last week, and he, after our event in April, he's booked solid on all of his speaking engagements through April of 2023 after our event. So he's in high demand. And this event, we're calling The Truth. And I have heard from so many clients and so many folks I've talked to all around the country that they don't know what the truth is. You
Right.
know, it's kind of like I watch one news station and I hear one set of facts, and then I turn and flip it over to a different one. I hear a different set of facts. And it's like, man, oh man, how can I make wise, informed decisions about the things that are most important to me with my finances if I don't know what the truth is? And I'm trying to figure that out. And so we bring in this event, we're bringing in, as you guys know, we always just speak facts, and we have no political bias. We just simply lay out the facts and bringing in an economist that is known just to speak the facts and be very bold about it. And so, you know, it's going to be an event. We're going to cover things about inflation, which we'll talk in more detail right now. It is just running rampant. I mean, my doctor last year told me I need to stop eating quite as much bacon, and I love thick cut bacon. So I went down to my butcher in Tremont and went to get my 1 pound of bacon, and it was like $11 for a pound of bacon for thick cut bacon. So I decided I'm not paying for my bacon anymore. Inflation has gone crazy, and so my doctor will be happy when I go see him next month. But
Okay, well,
you know, inflation is nuts. It's taken off, and taxes are increasing here in the next year. We've got war over in Russia with Ukraine, and we see earnings are being just kind of gyrating all around. We have unemployment at a certain level, and yet it doesn't seem like there's a huge disconnect as far as employment. And so Andrew's going to be there to speak things, and and whenever you sign up for that event, folks, there's a slot on there to put down whatever your main questions are. And so we're going to have a Q&A session at the end. And so it's going to be a phenomenal event. A couple of little surprises are going to be there that night also in East Peoria. Like Drew said, if you cannot make it to East Peoria, and we have clients all around the country, actually all around the world right now. And if you cannot make it and you want to watch the live stream, it's on Facebook. Go into the Creekmore Wealth Facebook page and definitely follow it, and so you'll get a reminder of the live stream starting up. And then we'll also have a recap video, and we will have the whole video actually available on our YouTube channel a couple days afterwards. So, Drew, it's a tremendous event. We'd encourage everyone to get registered, signed up, and seats are starting to fly off. So we have a limited number of seats, so make sure you get signed up for that.
yeah. Absolutely. So check out that link. We'll make sure to include it here in this email. And John, let's kind of dive into it. We're giving a little bit of a preview of what you're going to be talking about, the truth today. So let's kind of talk about it. You already referenced inflation. And so inflation is at a 40-year high. And it seems like every month when we get new CPI numbers or just new numbers on the cost of gas, whatever it may be, it just seems like things keep spiraling higher and higher on the inflation front. Can you kind of put into perspective for us how we should view inflation as it relates to investments and retirement planning? Is it a big deal? Is it not a big deal? Kind of put that in perspective for us.
Yeah, so we have short-term impact and long-term impact as far as with inflation. So in the short term, it's interesting. An article came out this last week, and it talked about people making adjustments in their spending, and it's going up and down the entire socioeconomic scheme. So obviously, lower income citizens, the real cost of inflation has got a huge impact as far as on daily living and decisions. If you were retired or on a fixed income, inflation has got a huge impact as far as on being able to buy your groceries and your gas and your transportation. At the end of the day, though, it also impacts as far as our overall economy. And so we see if people are making adjustments in what they're spending, that means that they're going to reorganize their priorities and say we need to focus more upon our base level or foundational items. So if you go back into your Maslow's hierarchy of needs, the base level really is our food and our lodging. Yeah. And so that's going to be the highest priority. But then the discretionary items we'll end up starting to spend less money on as an overall economy. Well, the discretionary items do play into really what drives the economy, and it has an impact as far as on employment numbers. And so if we're spending less as far as on our house, as far as to retrofit it or to refinish our kitchen or buy a new refrigerator, and so we're not doing that now, well, that means that there's fewer refrigerators being sold because the cost is too high. We have to focus on base level prices as far as on our food and our gas for our transportation. And so in doing so, that means that we're going to be spending less, which means that eventually companies will have to start laying off. And so it does have a pronounced impact in the long term. Now, as far as your investment portfolios, if inflation continues at its current pacing of over 7.9 or 8% or 8.5% in some areas from last month, if that continues on, then you have to say you need to have a quickly rising income during retirement. Yeah. And so if that is the case, you need to reposition your portfolio to be able to generate that for you. Now, at the same time, we also know that the Federal Reserve has a huge impact as far as on this, Drew, as far as with combating inflation. And so that affects the portfolios also. And typically, whenever we see one item transition, it affects other areas of the portfolio.
Yeah. Yeah, and you mentioned changing your retirement income drawdown strategy. Me and Andy, our director of financial planning, just did a video on that very topic. We'll also include it here for you to check out how we adjust the drawdown rate of your portfolio in retirement as life happens, right? As inflation is high. And John, you mentioned how inflation is addressed, and the Federal Reserve has recently come out and changed a little bit about what they're going to be doing to address inflation. And this is a really big deal as it relates to your portfolio, bonds, and how do you reposition? Can you kind of walk us through what the Federal Reserve has announced here in the last few weeks as to how they're going to start combating inflation?
Yep. So let's take a step back even to last year. And so, and I've told some of you this story. And so let's say you are in your car and you're pulled up to a stoplight and it's red, and all of a sudden it turns green. And the person that's parked in front of you at the stoplight is sitting there and they're actually having a conversation on the telephone with someone else in the car. And their hands are moving, they're really engaged in their conversation, but yet the light's green and the signal has changed and they're not moving. But then all of a sudden the light turns red and you're still sitting there. Well, then people are getting frustrated. The cars are piling up behind you. They're honking their horns. Maybe they're using choice words. But then all of a sudden the person realizes they didn't go. And so the light signal changes again to green. And what do? They slam down on the gas and they just take off real fast. As far as to make sure everyone gets through the light the next time. Well, the signal changed, and it changed from red to green to yellow, and the person did not go. With the Federal Reserve, they had certain signals that went off last year, about 10 months ago, 12 months ago, that indicated that inflation was starting to ramp up. And so the signals changed, and yet their actions did not change. And so in doing so, they all of a sudden then realized that inflation was going from a phrase called transitionary to being permanent. And the pace of inflation was actually accelerating throughout the rest of the year. Now, there was some policy decisions from the Federal Reserve that contributed to that, but quite honestly, there was other decisions that happened as far as in relief efforts during COVID. From a political standpoint, the legislature signed on by the president over a couple of administrations that actually poured fuel on the fire. And so, in doing so, then the Federal Reserve this year has made some decisions to really make some very stark adjustments as far as how they're handling monetary policy. So, number one is they're slowing down by the tune of $95 billion a month the buying of bonds from banks and insurance companies. And so, if so, that means they're not putting as many dollars to the tune of $95 billion into the system. And then when that is happening, that means that interest rates will start moving up a little bit. At the same time, they're taking interest rates from a target rate of 0% to 0.25%, and they've been increasing interest rates on the short term they already increased it once by 0.25%, but there's talk of between 6 and 8 increases that are going to be between 0.25 and 0.5% on each of those increases.
Yeah.
So that's like the individual slamming, all of a sudden didn't realize the signal had changed. And then all of a sudden it's like, oh my goodness, I got to go. You got to slow down this inflation train. And so then what do? They're raising interest rates quickly. In doing so, let's keep in mind, we look at the stock market as a sign of volatility. But the U.S. bond market is actually larger to a very large degree, much bigger than the U.S. stock market. And so whenever we see these drastic gyrations in interest rates, that has a huge impact that's going to basically trickle down through the entire economic system.
Yeah. And you mentioned how much larger the bond market is than the stock market. I mean, the bond market's the tail that wags the stock market. That's the dog, right? Mm-hmm. And I love this picture we're going to put up here that shows a teeter-totter. That shows the impact of rising interest rates on bonds specifically. So if rates go down, bond prices go up on the teeter-totter. And in reverse, when rates go up, bond prices go down. And so this year, we actually are seeing bonds are performing worse than the stock market. Bonds, as of right now, are off about 8% or down 8% year to date, while the S&P 500 is down over 7% year to date. And traditionally, you own bonds in your portfolio to smooth out the volatility that comes with the stock market. But we're not seeing that this year in large part because of the policies that we're seeing implemented at the Federal Reserve level this year. And so, John, what are we seeing, one, in the bond market? Is that telling us that, hey, a recession is coming, or we need to see the yellow flashing lights and be ready to move? Or is it telling us that, hey, be prudent and make some adjustments in your portfolio? What are we kind of seeing from that bond market movement so far this year?
Yeah, really the best way to manage your portfolios is never to make drastic changes from one methodology to another, but it's to be aware of what's happening overall economically and politically. Yeah. And then to say, we need to be ready to make small adjustment here or a small adjustment there, and to continue those small adjustments as you receive more and more facts. And so in this case here, we know the bond market traditionally has been a hedge against stock market risk. And you even look on old tried and true methodologies as saying, if you're in the retirement years, you should have 60% in equities or stocks and 40% in bonds. Or every year you get older, you should increase your bond allocation for safety.
Right.
In this environment here, Drew, it actually is introducing a greater level of volatility into portfolios. And so it's providing a very unusual environment in which we have heightened volatility in the stock market, which is really due to a lot of different economic impacts that have been put into play. Some, I think, is more organic, and some has been influenced by policy decisions globally around the entire world. And then we also have increased volatility in the bond markets, which really is being due not just to the U.S. Federal Reserve, but it is to all of the governmental monetary decision makers around the world, really giving mixed signals of where the economy is at. So, Drew, it presents a opportunity to make small adjustments in portfolios for everybody based upon their personal risk tolerances. But some general rules of thumb, the teeter-totter is a great example. We know as interest rates go up, the value of bonds go down, and the longer your maturity term on your bonds, the more they're going to be going down. So increase more volatility. So there's some adjustments that need to be made in portfolios across the board.
right? And so we've already made some of those adjustments in accounts by reducing fixed income or bond exposure slightly or significantly in some cases, depending on what people's goals are. We've replaced fixed income, John, with buffered or target outcome ETFs. And can you just refresh for people why we did that and what those ETFs or funds are?
Yeah. So with the buffer or target outcome ETF, and so an ETF stands for exchange traded fund, as you all know, is kind of like the brother from another mother, and so very similar to a mutual fund, right? And so just a little bit of difference as far as in the structure, but it's a packaged product that's inside portfolios. And with a target, we say there is a range that you can make on the upside, and your rate of return is tied to an underlying index, which would be the S&P 500 or the NASDAQ. We can even use gold. We can use international holdings. But there's an upside that you can make. So you'll earn 100% of what the market does over a 12-month period of time. And the ETF is liquid every day, so we can sell out whenever we want to. But you'll have an upside. So typically it ranges from 8.1 up to about 14% on the upside. But then also there is a limit or buffer on the downside. And so depending upon, we have two different flavors. One is a traditional and one is what we call a deep. And so on the traditional, on the first 10% that the S&P 500, that's underlying index, is down over the course of 12 months, if the market's down to 10%, you actually lose zero over that 12-month period of time. A deep buffer says if the market is down with our underlying index is down 30%, then your investment is only down 5%. And the question is, well, why 30%? Why is that used for the deep? And I had lunch with the manager of the strategy, flew in from California, had a great lunch with him. I asked him that very question. And he said, historically, if you end up protecting more than 30%, then you're capping your upside, and you could maybe have a 100% protection on the downside, but you're going to cap your upside to 1 or 1.5%. Whereas anytime the market has dropped by 30% within the U.S., the U.S. government has stepped in and infused cash into the system in a very short period of time. We saw a bounce back, and so you're paying an extra cost for total protection that's not really needed based upon historical norms. And so that's what a target outcome ETF is used. So we've actually used those in place of bonds because we do have a heightened level of volatility buffer, but we're still not giving up the downside risk as far as with interest rate cycles.
Yeah, and we'll toss in here some performance charts for you so that you can see how these funds have performed compared to the S&P 500 and the U.S. aggregate bond market over the 1 year and year-to-date time period. If we're using this as a proxy for some bond allocation, this is a really strong performing fund. So we'll include that for everyone to take a look at and kind of see why we've done that. And John, another piece that we're bringing out and beginning to introduce into client portfolios is something called structured notes. And historically, these are a type of investing tool that you had to have a minimum of $500,000 to invest in these structured notes. And so we've been able to have some great partnerships with large national banks and with First Trust to help us introduce this to our clients' portfolio. And it's a really great tool to have in a rising interest rate, high volatility in the stock market environment. And I made a video kind of diving really deeply into structured notes that we'll toss in here, but just high level it for us, John. Why would we consider using a structured note for a small portion of your portfolio?
Yeah, so really the structured note we're looking at as a bond alternative. And so the way the structured note, again, the video that Drew just referenced is inside the body of this email. Is a phenomenal video as far as down in the weeds, as far as how they work. But it's a way for us to have principal protection on the downside away from stock market risk, and yet still has some upside growth potential. And so we're continually looking for alternatives to bring some hedging or strategy protection into the accounts whenever we know that if we go with the traditional method of doing that, which is the bond market, that we're actually setting out for a break even at best analysis. So with the structured note, we actually are partnering with, and this utilizing some national banks. And so some big names out there, maybe a Goldman Sachs or a JP Morgan, a Citigroup, Banco Santander. And so we have a number of different larger banks, other ones also. We simply go to them. We let them know the parameters that we're wanting to work with on the note, 12 months, 24 months, 36 months. We're looking at which indices we want to utilize and what level of protection that we want on the accounts. And then in doing that, they bring back to us what the parameters as far as of the note. Do we want it for income to generate a dividend yield higher than what we can get with the underlying securities, or do we have a growth note that provides the potential to grow in the account? So no matter what your situation is, we have a lot of clients that are receiving income based upon dividend portfolios. This could be a great solution to add a little bit of safety, but also ramp up our dividend yield a little bit.
Yeah. And whether it's a target outcome ETF or a structured note or a fixed index annuity, or different types of stocks or bonds, John, I think kind of what we're saying here is diversification is key to help your portfolio and ultimately you achieving your goals, weather whatever economic storm is going on. And so can you just kind of give us a good wrap-up summary here of just some good planning best practices for folks to keep in mind as we're kind of walking through what maybe is a little bit of a difficult time period here?
Yeah, I mean, we always know that the seasonality of what we go through in life is it changes, right? So sometimes, as far as general weather, we go from a huge storm outside where we have 5 inches of snow all of a sudden hit with wind blowing, kind of blizzard conditions, and all of a sudden we have a really pretty spring day. We have a nice 85 degrees summer sunny summer day. The hit of the fall. So there's just certain seasonalities that hit. They have different beauty parts to it, but also some negative parts, quite honestly. Same thing on economic portfolios. When we look at financial planning, it's really about saying what are your goal objectives, short term, intermediate term, and long term, and then making sure that you have your portfolio structured in a way which will allow you to have the funds needed whenever the goal is realized. And so, in other words, if we have a goal that we need funds in 12 months, you're going to invest your portfolio a little bit differently than if we're building for a long term retirement income structure. Or if we're building for accumulation and you're 35 years of age and you're needing to accumulate funds, well, then your strategy is a little bit different. At the end of the day, we set the long-term objectives, you build the portfolio, and then you make small adjustments along the way whenever the seasonality changes. And so in doing so, you smooth out the ride and you have more of a structured rate of return. And that's what you're really looking for, is consistency month in and month out in order for you to realize the goals. Small adjustments along the way is the best way to manage the portfolio adjustments.
Awesome. Awesome. Thanks for wrapping that up for us, John. I know we've covered a ton of ground here. So if you got to watch the video a couple of times, totally understand. Shoot us an email if you have any questions or give us a call. We'd love to chat with you. And if you have the time, we would love to see you in East Peoria for The Truth Live, or catch us online on Facebook Live. It will be well worth the investment of time to hear from John and Andrew. But I dive into some of these topics a little bit further and kind of cut through the noise to get to the truth. So thanks for your time, guys. We hope you found this interesting, and we'll talk to you soon.